Welcome, everyone. We are back. Connor here continues to crush the market as it goes down 15%. But we actually have a new member here, Jordy. So, I've known Jordy. He's in the fund. We just kind of clicked off the bat. And he actually brought up that it would be a great idea, for Connor to go from the pupil to the master and start teaching people. So we figured what better person to teach than Jordy. Feel free to Discord me or put in the comments or message me if you guys, feel like you want to get into this. But I guess we'll start if you just want to give a quick intro of how you found us and what it's been like working with us so far, Jordy. Kind of like where you're from, different and stuff.
So originally from Barcelona, I live in London, very close to the King in Buckingham Palace. And I've been obsessed with options since 2020. And I've been going down the rabbit holes and this and that. And in one of the Discords, the trade pastors, I saw, lots of people. And then, of course, Raising Stars, I saw you, Mark, and I assaulted you and I kept texting you until you allowed me to invest in the fund. And then, we started talking. And I mean, I need people who are equally obsessed with options as I am. So yeah, you fit the criteria.
Mm-hmm. So I always appreciate Jordy and Connor that they're really trying to learn this quite quickly. So they came to me with a bunch of stuff and I was like, okay, if you guys are asking good questions and solving most problems yourself, we figured we'd open it up. But in general, I wanted to go over kind of Jordy's portfolio that Connor has kind of been working with him on and showing it. And then if you want to kind of run through your thoughts in regards to the portfolio, Connor, we can start with this. Also link it. But if you just want to go through, we can go line by line here. But these would be the first trade, which is an all open. You can kind of go through here, Connor, if you have any questions for Jordy in regards to this.
Yeah, the 932 looks good. That's pretty similar to what we were running. I did just kind of have a question on the second 932. When we were to preference this, we were looking at this beforehand. So we were looking at that $4 hit that you were looking at, and where'd you come up with that target?
Well, I backtested and backtested and backtested. So I started at $1, which of course everything was negative because you don't collect as much. I kept going up, and I think I even went up to $4.5, and then different widths, different like stop losses. And on paper, this seems to be, again, I spent hours doing that. And when I do the backtest, I don't even read what I'm doing. I just type numbers frantically. And then the next day when I'm fresh and I step out, this seemed to be the best one.
And was the $2 one, was that the second best one, or was that how was it? The $4 one was the best one, and that $2 one was pretty close too.
Yeah, well, then I start getting obsessed with saying, what if I try 225 and 210 and 215? And I said, okay, that's too much. So, I do have a question though. Like, I was thinking, if we use the wings as protection, and I've realized these past days with these crazy like tariff things, I never hit I get stopped out even before I hit the short like thing. Why do we bother testing 100 wide, 150 wide if we're never going to use that? I was thinking.
Yeah, so we kind of use this for buying power to just model the cost of what we're doing. So kind of what I've been doing lately is I'll split this up into separate legs and I'll just call it like a 10-cent call wing and I'll call it a 20-cent put wing. This is all good. The only thing I just want to point out on this is a little bit of a Frankenstein trade. So I think we could have curve fit a little bit. And what I mean by Frankenstein trade is like, this only goes to 2023. This only goes to 2021. Then this is 150 wide and this is 100 wide, where on a $4 option and on the put side, this would be like a 50-cent wing and this would probably be a 5-cent wing. So I would just say balance this out to like $2 100 wide, or this one $4 150 wide. And you also have to consider that like when we get stopped to the downside, we're going to take a loss of $20. And when we get stopped to the upside, we're going to take a loss of $14. So it's relatively balanced, which is what I like about this. But we'll just clean both of these durations up. It came in the back test fine. But when you're just comparing them, I just want to make sure those are right. Then next trade we have, I see this is from the most recent episode, so that one's probably good. And the last project that was kind of Connor and Jordy's homework was this power hour stuff. So I don't know if you want to kind of take the lead on how you got this, Jordy, or if you had any questions for Connor on kind of what you guys found in that.
I do have a question, sorry, before. On the portfolio, I thought that if you put the dates on Options Omega, independently of the dates of each test, it's going to run the whole thing. Or do I still...
No, it will. It's just from a standpoint of like you're looking at it in your current tabs.
Oh, okay.
You're doing evaluation on each individual leg before we do them. So it's just something to make note of. The most important thing is really the VIX on filter. And then with, you might as well take the extra $150 on this side since put wings are expensive. So this will probably add like $10 of expected value per trade. Then I actually found this one kind of interesting. Not quite my risk appetite, but in line with what I like. If you want to kind of explain this.
Sure. So I tested, everything. Like I started again quite frantically.
And to show you guys Jordy's work on how much he's gone, this is what he did back testing wise. So we'll share this too, so you don't have to do it, but I would recommend you guys do it to get as good at back testing as Jordy. And you can just see here that he has, several hundred back tests. Connor was driving him like a slave to do all of this, and he turned it around in about 48 hours. But you can see here that we got, I think, 500 lines of back test. So what'd you find? And I wonder if that's kind of in line with my thoughts, Jordy.
Yeah, so I started, first I say, okay, I start on the put side. Then I start the power hour at 10 o'clock, and then 10, 10, 15, 10, 30, 10, 45. Then I look at different credits, 150, 2, 250, 3. Then I try different widths, and then I go to 11 o'clock, and then I go to 12, and and then I found out that for some reason, at 1 p.m. and at 2 p.m., there seems to be Hedge, not before. And the richer the credit, the better. And the drawdown is not crazy. And then I did the exact same thing on the call side. All these ones I did, as Connor was telling me. So since I think it was 2000, since SPX dailies, and then I started to hone in when I selected what seemed to be working better on the put side and the call side. I started slicing it down for years, and then I just selected. Like I had the conclusions, and these seem to be the most optimal, at least on paper.
Yeah. So one question I have that's kind of open for both of you, and it doesn't have to be right, but this is just something I'm noticing, is that, these both roughly collect the same credit. We've done a good job with matching the 100 to 100 buying power wise, but one has a 550% stop and one has a 250% stop. So in both of these per Jordy's back test are the highest dollar like premium capture that we're going to get. However, how do you think this could potentially work in a portfolio? And do you think that by having one side, when we lose on it, it loses roughly twice the amount of the other side? That could affect our portfolio.
I think it could affect it depending on the day. So if they both draw down pretty hard, I feel like that could be is that kind of running into what we were talking about last week where it clusters a little bit? Is that clustering it a little bit?
Yeah. And the other thing I want you guys to think about is, if you remember in the last video, we were looking at the spreadsheet and we're like all in it open and the reverse iron condor, that combo has the highest Sharp or MAR of the whole group. Then we added in a calendar, which was worse, a power hour put, which was worse, and then like another 10-15 trade that was worse, that were uncorrelated. And by putting in the worst trades, it made the portfolio better as a whole. Yeah. So even though we've maximized our expected value on each of these, since our risk to reward is a little leaned, like we'd rather the market go down than up. And we'd rather, where if it stays in the same place, we're going to be fine. But I would say that we could probably potentially cut this drawdown out. And I'll just do this from the top. I guess the point I'm trying to make is, if our max drawdown is at 13.8%, is that max drawdown all coming from when we rip to the upside in power hour? You know what I'm saying? So even though we're making money, we may be able to cut this drawdown down to like 8%. if we now size this at a 300% stop loss. So the risk is roughly the same on each side because we're positioned with this that in an up market at the end of the day, this is going to whack us basically. Because this is a lot of the premium we're selling. And then it could also be on the same day when it's really strong trend that we're getting stopped out on the call side here as well. You know what I'm saying?
So quick question. So basically you're keeping that diversification by having different stops on there, but you're also not, you're lowering that drawdown. So you're not getting whacked as much at the end of the day when it ticks up.
Yeah, you just have to kind of think about it. So look how he's positioned at the beginning of the day. We have a 700% loss and 500% loss.
Yep.
$20 loss, $14 loss, relatively similar. Then when we go to power hour, we have a $10 loss versus a $5 loss. So if we rip up here, now we're leaning 2-to-1 on this side. Granted, it's offset slightly. And if it's on a day when we have like the reverse iron condor, this would help offset us. So this portfolio is solid, what Jordy's built, even risk, highest expected value, but we're leaning a little, we don't want it to go up as much, which is not necessarily the best stance to take in the market. Would have been great lately. And on days when we have the all-ended open, we're going to get hit by this and we're going to get hit by this. But on the other day, we're very diversified because we want the market to continue to go up when we have a reverse iron condor, because when we get stopped out in this, we're going to make more money because it's going to continue to go up.
So you seem to imply that 13% drawdown is high. What is the maximum drawdown you want to look at?
This is at the upper end of what I like. So I would say 10 to 15% is the highest I'd get, because if we're off at 10 to 15%, worst case is probably 20 to 25. Whereas if we're off at a 25% drawdown, we could be at 40 or 50. You know what I'm saying?
Well, because I have found some great trades that have a drawdown of 40%. And I'm thinking, I would do that. But of course,
Yeah, you got to follow through,
Yeah, exactly.
It's like the person from the bar sounds like a good idea until you got to spend more time with them. It's the same idea with a 40% drawdown. But what I'm saying is I think you could make basically the same and lower this drawdown by maybe bringing down the stop loss. You can put it in the spreadsheet, something to think about. And at very least, I think our risk to reward would come up. So maybe we make less PCR. This goes down to 20, but our MAR goes up to like 3.5 or 4. And then we can just size both of these trades smaller with a smaller stop loss. So if you think about if we size this call trade at a 250% premium capture, we could technically trade twice as much and we only have to make half as much money because the risk is less. That makes sense?
Yeah, I'm still, when you say all these things, I still have to see it. So, I still have to back test and see that. It makes sense, double, less, but
let's break it down to how you could kind of like learn to fish. So from what I've said, what do you think would be the best course of action to try to solve this problem? Either of you can answer.
Go back to the back test and try different stop losses. And maybe
portfolio. You already this is the best call. You know what I'm saying? But you don't know that if you choose a worse call with 300%.
But hold on. It's the best call with these parameters. If I decrease the stop loss, yes, I'm going to lose less, but I'm going to get stop loss more. So it's going to affect the KGAR, won't it? That's the thing that.
So I guess the concept here is like if you are able to bring down your MAR, which is your risk to reward, even if it brings down your premium capture, you can make more money. And the reason we could do this, let's go back to the wheel thing. Like if we double our MAR and we only lose a quarter of our premium capture, so we go to a 5 MAR and we go to a 20% premium capture, we could trade twice as large and have less of a drawdown, which could get us to 40% with a 10% drawdown or something. So we could actually trade more contracts that make less money, but if it helps offset our risk more, we can size them larger.
So the way to, I'm going to make a confession here out in the open. I don't really look at the PCR. I look at it, but I'm always obsessed with the KGAR and the drawdown because I think that the PCR is kind of like a consequence of that. So
correct. So you're thinking of it right, but I guess the way to phrase it in that way would be if you added more contracts, but with a less stop loss, could you get the MAR up?
So the way to test that would be to put 250% stop loss. So have the stop loss and double the contract on this particular one. Is that what you're saying?
Yeah, I think we can actually look at it here in your spreadsheet real quick. So the bottom part, 14, yeah, this is 1 o'clock. So if we're looking at the call side, which should be the next one.
Yeah. Scroll down. Yeah.
Is this it or this one?
Yeah.
Right?
Yeah. Should be down there.
So the 550 has a PCR of 12%. So if I go 12% times, is a $250 premium, right?
$2, I think.
200. So our expected value is $24 on that.
Yeah.
And then if we go up here, I'll just do the same thing. Our expected value only goes down by $3. So you could see here, if we reduce the stop loss by $100, we only lose $2 of expected value. Okay.
Uh-huh.
And then here's another concept too. And this is like, looking back in hindsight, I think I may be confusing you guys with doing it all in the portfolio to start. But if we go to, where were we just at?
So just to kind of clarify, what you're saying is you're bringing down the risk, but you're multiplying the contracts to make up for the money that you wouldn't be making.
Yeah. And here's how we can calculate the MAR real quick is we go absolute value that makes it non-negative. And we go by the drawdown. No, I think it's CAGR. Oops. ABS. So we'll go absolute best value, CAGR divided by drawdown. So this gives us a risk to reward. Our risk to reward on this one, actually zoom in here for you guys. Our risk to reward on this one is 0.93. Then we'll go down here. Okay, you may be right, Jordy, but
I don't know what I'm talking about. I don't know what I'm right about.
No, but these would be like the two that I would look at.
All right.
And these ones definitely suck. You can see the math there is like 7 divided by 26. That's not going to be good. That's a 900% stop. Or 200, it doesn't even make money. However, yours is a 1.02 risk to reward, and this one is a 1.10 risk to reward. So, and losing 20% less money, you are only making with a 20% smaller stop, you're only making 10% less money. So just from looking at this, I think by plugging this in there, it would make you more money.
Would you also, so you're also going to have to change to keep the risk to reward on the other one, or are you going to change the other one to 225?
I think it'll be fine with that because now we're cherry picking potentially too much. And this is just a thought. So if you plug this in here, Jordy, and it goes to 12 and this goes to 2.9, forget about it. It's not worth it because it wasn't materially different. However, if you plug this in and it goes down to 7%, we got to take that.
Whoa, yeah. But do you think it could impact it that much? I mean,
no.
I don't know. Okay, I wish, right?
Yeah.
Yeah.
But that's a way to think of it, and it's like, if I'm reading the tea leaves, I can tell you that the days you lose the most money are when the VIX opens up because you have exposure here and you're not able to offset it with the reverse iron condor. So maybe we look at something that helps us, like a call that helps us around this time too. If the market goes up, we could, salvage some money as well. So I would say that's the biggest weakness from what I'm seeing. So maybe we add something, but this is more like a concept. I guess that may have been too deep. Do you guys have any questions? And I promise not to answer them with more confusing stuff.
No, that makes sense. I think that just kind of goes back to like the expected value equation and just like applying that to your trades. I mean, that's what I got from it, but kind of like Jordy Simbo, I'll definitely have to go apply this for a while to really make it make sense to me. But I think I got the core concept of it.
Yeah. And generally what I'm trying to avoid is that market condition comes up when the VIX opens up and it rips to the upside at the end of day. And then you have a larger drawdown than 13%. You go, how do I trade now? You know what I'm saying?
Exactly.
Okay. Because there's so many combinations. I'm starting to plug in, okay, what if we do 2 contracts of this and 1 of this? What if we do 4 and 3 and 1? What if I only open it on Monday? What if I only open, I mean,
that's called curve fitting.
No, I mean, not looking for, but yeah, you know what I mean. Yeah, it's too many things to consider that.
Yeah. In kind of when we go through this, I don't want to confuse you guys where it's like, we've got a power hour trade, we've got our open trade. This is great. Maybe we could change this slightly in the power hour spot, but if not, we can just add one more trade. I think this is pretty solid after looking at these numbers. And this is also what's good that I want to point out to people is when you do everything in the spreadsheet, it's much easier for us to go back and think than rerunning 40 individual back tests that take 90 seconds apiece. So kudos to you, Jordy, in doing this. Then my next one is Connor brought me a trade here. Jordy has never seen this. So looking at this, Jordy, what do you think of this trade? And what's your opinion on it or maybe flaws with it?
Okay, so KGAR, I'm just looking, I mean, just what I would do. So for almost 40% with a drawdown of 12%, that sounds really good. I see that, I mean, PCR 3.2% sounds very low, but with that KGAR, I mean, my first impulse is who cares? Of course, I'm sure it's important, right? But that would be my honest answer. But if I look at what the trade, I mean, so I also see that it's only been 2025, so the period is very small. So I would be curious to see.
This was a really good catch.
Okay.
Because if anyone's been trading this year, stuff's changed.
Yeah, just exactly. It's been a little bit of MAGA, right? Whatever. So and then so you're selling a put, you're buying a put, you're selling so it's an iron condor. I see that it's very tight, like 70, like the width. It sounds very small. I've tried to go lower than 100 on my back tests, and for some reason I didn't like it. Through 3.5 and 3 open trades at 2:20 p.m. Whoa, okay, that time sounds daily exactly. I don't know. I mean, the slippage
things that bring up the biggest red flags to you in this back test.
Again, the PCR, the dates.
What about
definitely
the PCR? Good or bad?
That 3.2%. It's, I mean, the max. Look at the max loser, 4,000. That's crazy.
Okay, second thing, max loser. So like low premium capture. So we can go from making money to losing money. Max loser. This shows me that if our average win is $900 and our max loser can be $1,400, this could easily lose 3 or 4 more times in a row, and we were at 40% drawdown. What's one other thing that you notice? You can phone a friend and Connor here if you need to.
I mean, I've just seen this, so my head is like trying to. So I guess the required to price like profit take. So there's a profit take.
This is good. I don't like the 70 wide because we're managing a 4-leg order, which will be hard, especially in fast markets. Yeah. However, I do think this will hit this. I also ran this out to 2022. I mean, like if I was capital constrained, I could run this, like if you had a really small account. However, this reminds us of the 10-15 trade that Connor did in the past. That's $3 or $4 and has the profit take. And it's like, you can't double proposition this buying power. The premium capture is, low. I would maybe be curious about increasing the stop and increasing the profit take here. But in general, I would not recommend that we run this in our portfolio. And I like Jordy's power hour, above this. Maybe we add this to the portfolio in a 1 lot, Jordy, and see if it improves it just for, curiosity's sake, because this is a little more neutral of a trade.
But yeah, I'll tell you my thought process behind this. Like my thought process behind this trade was like, we were getting killed at the open in our portfolio right now. And our flies were coming in and doing really well for us. So I was like, and it was saving our flies were saving the day. So I was like, what can we do to try to capture some premium in the middle of the day? And then so we can be more net positive. Like we would end the day like plus 600, but we would also be like, we're coming back from like, we're doing like a comeback victory every single day, like down 600 at the beginning of the day. So I was thinking if we can get this at least to like a minus 100 or even break even on one, and then we could be like, plus 1200 at the end of the day, that would help us out. So that's where like kind of my thought process was behind this trade, to try to find something that where do that. And that's why I was pumped about this being in the last 30 days. I mean, the last 90 days, it collected $9,000. But I honestly didn't even realize the max loser being negative 4,000. So that's a pretty red flag for me as well. So I didn't. That's a big.
I would say this could potentially have legs to it. I'd be actually curious what this max loser is. Just because 2,000. Yeah, I'm not sure where that is, but I think this could have legs to it. If we can get this to 2.5, I would run it. And I think your thoughts in the right place. So we can play around with this and see maybe if there's something there, or if anyone in the description finds something, feel free to drop it.
So the parameters that the guy I was discording about this was said he runs at 60 to 80 wide, $3 all the way up to $3.05. So I ran. I played with that a little bit. 3, 5, and 3 was too big of a gap really on there. It just didn't seem like it was running too hot. So 3, 2, and 3 was running all right. But there's still, this is a very non-beat up back test still. Like I ran it pretty decently, but like didn't run it like Jordy.
I think it's pretty decent. Like we don't need exit slippage because we have 2 hits. For a 4-legged order, 2 hits is going to be solid. I think this will actually outperform in real life a little bit. But I would just say if we get this to 2.5, it would look really good. The risk to reward is just what I want a little more. This looks really infrequent. You can see our average loser is 1,700, average winner is 1,800. So it's roughly a 1-to-1 risk to reward. But that means we don't make money if it's like a 66% win rate. So that's just
I was thinking that this could be one that we plug into this market, and then after we get out of this market, we just take it out of the portfolio and plug like the power hour one. I thought this was just one of those that we could just run for a little bit to see if we could capture any premium.
How do you define this market? When VIX goes down to something reasonable, or how do we know we're going to be out of the market?
There's not a huge amount of data with what we're doing now. So I would just say in general, I don't really expect stuff to perform much differently. In the short term, it can. So like just make sure you're sized to be able to live through some drawdowns, because I wouldn't be surprised if you start hitting drawdowns as big as your back test. But if you're size small enough, I would still run stuff. That one could be a little fishy managing on the verticals because we get a lot of slippage, but we're kind of in a learning process. It's not like we're staking our entire retirement and our mortgage on this. So for risking, $2,000 a day for our account, that's, not that big. I think we could handle it running it, but we got to do a little more research.
Percentage wise, how much is that? Like when you say $2,000, like give me an idea in percentages.
$2,000 would roughly be like
4%, I think.
Yeah, 3.5-4% of our account. Okay. So it's a little large. Maybe we bring in the wings or we collect a little less premium on it. But we could potentially look at it. I would just wait and think a little more, because the flip side of this, Connor, is if we lose in it all in an open and we lose on this, that day's really going to
hurt. Really screwed.
Yeah. Or I would think maybe managing on each side would be a good idea. So like we can still use the profit take, but we'll lift the call leg or the put leg separately. Because if we get stopped out on one side, we should be.
It made it worse. I was hoping I tried to do it, and it made it worse. And I was
it's probably not the best one, but I think Jordy's combo may be a little better for us.
Yeah.
So I think
Jordy's is better for sure.
Yeah.
Let me ask Connor a question then. Connor, given my current portfolio that you've seen, what is next for me? What would you recommend me to do now? Look for other trades, or just let it run for a while? Or
I mean, this is a crazy week, but I'm just talking about in general. Just in a normal week, you can start seeing like, all right, what could my portfolio use here? Like my on and open, I'm getting killed at it. All right, maybe I need to make some tweaks to it, or if the math is right, then just keep holding on. That might be a trade that will turn around at the end. But just keep letting it run and keep watching it. I think you'll start and studying a lot, listen to what other people are doing, you might be able to see how you start plugging that into your portfolio. And just because you find a trade that's good, that doesn't mean, oh, this is going to change my portfolio. Like, you still have to plug that into the portfolio calculator and make sure it fits into your portfolio. But that's where I would start out.
Yeah, I think if you just run it for two weeks to a month, that'll kind of give us a better idea.
Okay, so and we decided on 250% stop loss, even though the back test seemed that it was, better to do it larger. I think it at 250.
Looking at the numbers, just keep it where it's at. I think it'll be a marginal difference just from, I've done enough back tests when I'm looking at that, so I think it's solid.
And also, the power hour also looked very good at 1 p.m. I don't open anything else, right? I don't do 2 power hours.
So I would make that a note. I would say if 2 to 3 or whatever does well, we'll look at adding 1 to 2, because that would be better than doubling the size on 2 to 3.
Okay, yeah, because now I'm doing 2 to 3, and 1 to 2 was also, it was almost the same. It was a slightly worse, but slightly meaning like CAGR of 2% less or something, like probably negligible, less than 10% worse. So,
yeah.
But I don't do it yet, right?
No, just let's do it for a month and then we'll come revisit it.
I just hate this patience game. Oh, Lord. Okay, yes.
Dude, you make it blown out. You don't want that to happen.
No. I know, but I'm just thinking, okay, that's fine. Okay, I'll do it.
I mean, maybe in 2 weeks you could change it, but I'd let it go for a little bit.
Okay, fair enough. Yeah.
I will say, from us running this for like a year, it's been a big patience game. Like, we started running this portfolio in like July. Not a lot of people know this, and like we did a lot of putting the pieces together in this portfolio. And now this year, it's been running really well, but it took a lot of beating up. We talk about beating up our back test. You have to beat up your portfolio a lot too. Like, we figured out, we were sizing it too much. We got to resize it right.
But you know what I mean, right? You look at these CAGRs and all these back testing and all that, and you think, why don't I do 10 contracts of these? Like, I'm going to go to the bank, get a loan, get 10 contracts, and then, like, that's what my brain... Thinks. Exactly. Dude. And that's why I'm saying it out loud, because I need to get it out of my system, because it's so counterintuitive to just be running it small. I just hate it, I understand it's necessary.
Mark makes a really good point, because like there's a great trade that I think that you're exactly saying. There's this guy that he shows 80% wins, like an 80% win. You're like, oh, why don't I just go all in on it? And it changes year over year. Like, his trades have never been the same. Like, so you look at it performing this on 2024, he comes up with a new strategy every year. And then you look at the 2024 for 25 this year, and it's just all red. Everything's dropped. It's just went to crap. So if you go bet all in on one strategy, like, it could, there could be your whole entire retirement, or you never know. You don't want that. But that's what I've seen from it. It is a patience game for sure.
Yep.
Okay. Cool. Yeah, I'll stay put then.
Sweet. I think we were good with that. Well, if you guys have any more questions, I think that was pretty solid.